Season 6, Episode 2, How Investment Income is Taxed, Visibility and Timing. If accounts are containers, then taxes are the rules that govern how the contents of those containers are seen. And one of the most important things to understand about taxes on investments is this. In many countries, including the United States, the tax system doesn't primarily tax wealth itself. It mostly taxes events. Something has to happen for the tax system to notice your money. An asset has to generate income, or it has to be sold, or it has to distribute profits. Until then, much of what is happening inside a portfolio remains invisible. And this idea, visibility, is the first key to understanding how investment income is taxed. Let's start with a simple example. Imagine you own shares of a company. If the company pays a dividend, that income becomes visible immediately. The dividend is distributed. The payment is recorded. The tax system sees it. Taxes are triggered. But imagine instead that the company keeps its profits and reinvests them. The value of the company may grow. Your shares may rise in price. But nothing has happened yet that the tax system recognizes. There has been no taxable event. The value increased, but the income was not made visible. This leads to a surprisingly important insight. The tax system treats different types of investment income very differently. Not because one is inherently better than another, but because they become visible in different ways. Some income is visible immediately. Dividends, bond interest, rental payments. Other gains remain invisible until you choose to make them visible. Capital gains, for example, usually appear only when an asset is sold. Until then, the gain exists, but it is not yet recognized by the tax system. The income is real, but it is still unrealized. This brings us to the second key idea. Taxes are not just about visibility, they are also about timing. Even when income is taxed, the question is when. Some investments generate income that must be taxed every year. Bond interest is usually taxed when it is paid. Dividends are usually taxed when they are distributed. Rental income is taxed when it is collected. These are immediate taxation systems. The tax system sees the income as it occurs, but other investments operate very differently. Capital gains, for example, can often be delayed. The asset grows, but taxes are postponed until the asset is sold. This means the investment can continue compounding without the tax system taking a portion each year. And over long periods of time, that difference in timing can become very powerful. But timing can also be reshaped by the container the investment sits in. Remember from the previous episode, accounts are containers, and those containers change how the tax system sees what is happening inside them. For example, in a taxable account, dividends are typically visible immediately. The tax system sees them each year. But inside a tax-deferred account, those same dividends may not be taxed until money is withdrawn decades later. The income still exists, but the container delays when it becomes visible. In other containers, like Roth accounts, the income may never become visible to the tax system at all. The income is real, but it occurs in a structure where taxes have already been settled. So we begin to see something important. Investment income is not taxed according to a single rule. It is taxed according to two interacting forces: how the income becomes visible, and when the tax system chooses to recognize it. Visibility and timing. These two forces explain almost everything about how investment income is taxed. Once you understand this, the complexity of the tax system begins to feel less mysterious. Different investment types trigger visibility in different ways. Different account structures alter the timing of recognition, and together they create the landscape investors must navigate. But the goal is not to memorize every tax rule. The goal is simply to understand the architecture. Because when you understand the architecture, the rules begin to make sense. They are not random. They are simply different ways of controlling visibility and timing. In the next episode, we'll start exploring the first major container most people use: the taxable account. It's the most flexible structure available. But that flexibility comes with a cost. Because in a taxable account, almost everything that happens inside the portfolio becomes visible to the tax system right away. And that visibility creates a kind of friction that every investor eventually learns to manage.